Hello, everybody. We're going to give it a couple more minutes just because there's some people signing in before we get started. While they're getting signed in, I wanted to introduce Rocky. He's the main presenter today on tax planning. A little bit about Rocky. He is a certified financial planner on the GBS Retire team. He's an expert at everything estate planning wise, tax planning strategies, a lot of everything goes in through personal finance. We're excited today to be talking about tax planning. It's a topic that is often overlooked, however, can make a big impact on your finances. So we're excited to have Rocky and that he is taking some time to go through that. As questions arise, you can submit questions to the Q&A, and then at the end, we'll also have a way for you to contact us if you want to contact us outside of today's webinar. That being said, I'm going to hand it off to Rocky, and we'll have him go from there.
Awesome. Thanks, Chad. Excited to be here today to talk to you all about tax planning a little bit. First of all, before we go into that, just a quick reminder of who we are with GBS Retire. We're part of GBS Benefits, so most of you here today are familiar with GBS Benefits. We are the retirement side or the retirement arm of GBS. And so with that comes some general financial wellness, retirement consultations as well, doing these monthly webinars that we're excited about. Had some good attendance at our last month and are excited for this one today. Be a bit more specific than our last month's webinar, more on tax planning. A quick plug for our survey that we send out at the end of this presentation, as well as in the follow-up meeting tomorrow. There will be a survey. I encourage you to take that. We're always trying to improve on these presentations and eager to get your feedback there. And then lastly, before we dive in, just want to highlight this disclosure at the bottom. We are not tax professionals. We don't want you to take this as tax advice. We'll cover a lot of general ideas, but we always encourage you to run that past a tax professional before implementing, because everyone's situation is a little different. So with that said, I've got a lot that I'm going to go into today, so I want to make sure we have enough time for that and questions as well. Like Chad said, put any questions in the Q&A. We'll try and get to them as they come up or at the end as well. And then if we don't have time to get through all the questions, we can follow up with you afterwards as well and answer those questions. So I'm going to go through a few different things today. Again, very high level, generally speaking, around tax planning from a financial planning perspective, right? That's what I do day in, day out, is financial planning, helping people along their financial journey to retirement and through retirement. But tax planning is a big part of that. Tax planning is one of the 5 areas of financial planning, and a big area because tax planning can make a big difference in your overall financial plan. One thing that kind of separates financial planners from CPAs when it comes to tax planning is oftentimes CPAs, and CPAs are great. We love CPAs. Always encourage you to work with one if you have a more complex tax needs. Sometimes CPAs focus a little bit too much on today's taxes. Right? Tax preparation, which is absolutely necessary, but how can we save in taxes today? Which is great, but sometimes we need to look at the big picture. Long-term, how do we be more efficient in our taxes? Long-term in your financial plan, sometimes that even comes and means we have to pay more in taxes, or we should pay more in taxes today to reduce our tax bill in the future. I'll get to some of that, but here are the things we're going to go through today. I want to do a quick introduction about what is tax planning, why is it important, and then understanding how we're taxed. Different types of income, how we're taxed on those incomes, and then include a couple different strategies and tips as well to hopefully give you some tools to implement in your tax planning. Most of the stuff we're going to talk about today, hopefully it's pertinent because, tax season is upon us, right? Hopefully most of you are at least most of the way through your taxes this year. Obviously you have until April 15th to file your taxes without extending for 2024. But most of the stuff we're going to talk about today is not necessarily around this year's taxes. It's planning long-term, those different strategies that you can think about and hopefully implement in your financial plan. So first of all, why is tax planning important? I think we kind of all get a general idea of tax planning in general, but I want to go through a couple different examples to show you really the power of how strategically planning your financial plan in regards to taxes can make a big difference in your overall plan. I'm going to go through 2 examples here. The first one with Emily. They're both going to make the same income, so $150,000 in 2024. In this example with Emily, no tax planning, not a lot of strategic planning in her taxes, doesn't contribute to a 401k or other tax qualified accounts, misses out on deductions and credits, sells individual stocks without considering capital gains tax liability and implications there. As a result, in this example, she pays around $35,000 in federal and state taxes at year end. So this year when she's filing taxes, paying 35 grand or had 35,000 withheld from her paycheck. John, on the other hand, does a little bit more smart tax planning. He's thinking about it a little bit more, thinking about different deductions and credits that he can take advantage of. So John contributes to a 401k, a pre-tax 401k, I should add, that reduces his taxable income, contributes to an HSA as well, further reducing that taxable income, claims, deductions that he can, charitable deductions, mortgage interest, and strategically sells stocks to minimize capital gains tax, and as a result is able to reduce his tax bill by $8,000. So $8,000 less that he's paying in federal and state taxes because of strategic tax planning. Now, obviously, this is a simple scenario, hypothetical. It doesn't cover all different aspects, but it shows fairly clearly that just a little bit of planning, a little bit of strategic allocation to retirement accounts, qualified accounts, making sure you're taking advantage of deductions and credits can save you quite a bit. And if you do that, if John was to do that every year for a 20-year time period, $8,000 a year, that's going to add up and could potentially be, hundreds of thousands of dollars over a career and retirement in terms of tax savings. So tax planning is very important just because, we all know we want to pay as little as possible to the IRS, right? We understand why taxes are important and taxes can be very important for our economy, but even the IRS understands that we want to lower our tax bill. The whole point of the Internal Revenue Code, which is the code that dictates how we pay our taxes, what kind of deductions and credits we can get, is there to help us reduce our tax liability. So before we can talk about different strategies and tips around your taxes and tax planning, it's important to understand how we're taxed. And before we do that, we need to look at how the IRS classifies our income each year. The IRS classes our income into 3 different buckets. And this is very important because the IRS wants us to make sure those incomes are separate buckets from which to pay taxes on. And the reason why that is important is because, take for example, our active income bucket. So with active income, that's going to be earned income, W-2 income. If you have a small business, those are going to fall under the active income bucket. Then you have passive income. What falls under a passive income bucket is going to be, as it sounds, passive income. So if you have a real estate rental property that you're not full-time engaged with, that is going to fall under passive income. And then there's also investment income. So if you buy and sell individual stocks, that is going to result in some investment income or losses. And those all have to be kept separate. And what that means is, generally speaking, we cannot take losses from one bucket and use that to offset gains or income in another bucket. And the reason why I bring that up and start with that is most of us has the bulk of our income under the active income W-2 bucket. So a lot of people come to us and say, what kind of strategies can we implement? What kind of real estate or investments can we look at that will reduce our taxable income in the active income bucket? And generally speaking, it's very hard to do that. There are a couple exceptions, and we can talk about that, but generally speaking, you cannot take losses from one bucket to offset the income in another bucket. So what that means is, particularly with regarding the active income bucket, we have to look to other strategies within that same bucket to reduce our tax liability there. So how are we taxed on income? I'm going to focus mostly on the active income and the investment income bucket today, because that's, for the most part, most of us are going to have at least the earned income, active income bucket, and maybe a little bit of investment income as well. So when it comes to earned income, there's a number of different taxes that we pay. And I get it, we all don't like to pay taxes, but that's how it is in the US. We just have to learn how to deal with it and to reduce as much as we can. We'll see federal and state income tax. That's really where we're going to be focusing on these 2 bullets, is in terms of reducing our federal and state income tax liability. The other form of taxes on our earned income is going to be FICA taxes, or often called payroll taxes. That's going to include our Social Security taxes and Medicare taxes. Most of us, if not all of us, pay FICA taxes. Occasionally, you'll have an employer that is able to opt out of Social Security taxes, and you may not see those, but you will still see the Medicare taxes. In that goes to fund the Social Security system and Medicare system, flat 15.3%, regardless of what type of earned income you have, whether that's W-2, whether that's self-employed, business owner, you're always going to have that 15.3% taxes on your income to pay those FICA taxes. Like I said, it's the federal and state income taxes that we have some relative control over and ability to reduce that with different strategies. Now, when it comes to investment income is taxed a little bit differently. With investment income, we have what's called capital gains taxes, and then dividends and interest. So the different types of income we get from our investments going to be interest and dividends. Probably familiar, heard those terms before. Capital gains may be a little bit more foreign. Capital gains is essentially when you buy and sell an investment. So if I buy a stock for $100 and then a couple of years later I sell that for $200, that's a $100 capital gain that I realized on that investment. Because it was held for more than 1 year, in that example, it was a long-term capital gain. I'm going to touch on investment income, kind of how that fits in here in a minute. But I want to talk about how we're taxed in terms of federal income. So our federal income tax bracket is based on a progressive tax system. And what do I mean by that? Let's use an example. Let's say 110,000 of income. And I'm going to use this example throughout the presentation today. So let's say I'm a single individual with $110,000 of income in 2025. That'll put me squarely in the 24% tax bracket you see here. But does that mean that every dollar on that $110,000 is taxed at 24%? No, because we have what's called a progressive tax system, that means we follow all of these tax brackets up to 24%. So that means 0 to 11,925 is taxed at 10%. And then the rest up to 48,475 is taxed at 12%. So on and so forth, up to the last 6,000, 7,000 is then taxed at 24%. This is important, an important principle, because when it comes to lowering our tax liability, it's important to know that we are lowering it relative to these tax brackets and trying to get out of obviously the higher tax brackets and keep us in the lower tax brackets. What you'll see when you're doing your taxes, if you're using an online tax filing, it makes it easy to see. If you're having a CPA help you prepare those taxes, you'll also see, likely at the end, what's called your effective tax rate. Your effective tax rate is essentially the average tax rate that you are paying on that income. So if you were to pay 24% on all $110,000, you'd pay upwards of $26,000 in taxes. But through strategic tax planning, you can get that down significantly. And because we use a progressive tax system, your effective or average tax rate is probably going to be closer to 6 to 15% on that $110,000, based on how many deductions and credits and different strategies you can use to reduce your overall taxable income. So it's going to be important as we talk about some of these different strategies today, because we're trying to think of how we can reduce our total adjusted gross income to be a lower taxable amount. The main types of strategies that we can use with our W-2 income, right, aside from some of those very few exceptions that most people don't qualify for, the biggest way to reduce our taxable income is through deductions and credits. And these are very clearly written out in the Internal Revenue Code as ways that we can reduce our tax liability. So it's not a loophole, it's not going around the system, it's actually working with the system to help reduce our tax liability. So deductions and credits are the main keys. Going through deductions really quick here, we have two different types of deductions. There's the above the line deductions, and then below the line deductions, which are often called itemized deductions. Above the line deductions are typically better than itemized deductions because we can take advantage of them regardless of whether we use the standard deduction or if we itemize. So you can see a couple examples of the above the line deductions: pre-tax 401k contributions, HSA contributions, student loan interest, alimony. I put that on there. If you entered into the divorce and were paying alimony before 2019, then that is deductible. If it was after 2018, so 2019 or later, that alimony is no longer deductible. Once you have those above the line deductions, that reduces your total taxable income. So let's say that across these, different above the line deductions, I get my $110,000 income down to $100,000. So let's say there's $10,000 of just pre-tax 401k contributions, and that's all I can qualify for. So now I have $100,000 of income left over that's going to be taxed after we consider the standard deduction or itemized deductions. So the itemized deductions are essentially where we look at if they're larger than the standard deduction, we'll go with those. So mortgage interest, state and local income taxes, medical expenses, charitable donations, those fall under the itemized deduction category. And if those itemized deductions all added up are greater than the standard deduction, which now is around $30,000, just under that, then we would use the itemized deductions. If not, we would stick with the standard deduction. And because the standard deduction has risen quite a bit in the recent years, fewer and fewer people are actually using the itemized deductions. Quick note on mortgage interest here. I find it funny sometimes when I meet with individuals and they say, I can't pay off my house, or I don't want to pay more on my house, or I have to have a house to get that mortgage interest deduction. And then we go into look at their taxes and they're not actually even using itemized deductions. They're taking the standard deduction, so that mortgage interest is not even benefiting them. So mortgage interest is a below the line deduction, as is charitable donations, which are very common here in Utah, but there are some strategies you can use to increase those itemized deductions on a year-to-year basis. What I mean by that is sometimes it's helpful to look towards the end of this year, or as you go throughout this year, keep an eye and keep in mind how much you are paying for those itemized deductions. So keep in mind how much you're paying for mortgage interest, state and local income taxes, medical expenses, and charitable donations throughout the year. And then towards the end of the year, you can look and see, is it close? Are my itemized deductions close to the standard deduction? And what other type of deductions can I get? So one example that's very common here in Utah, a lot of people know that they're going to make 10% charitable donation of their income. And sometimes I've heard, every person is different, but if you want to prepay those charitable donations, you're able to. So towards the end of the year, if you see you're close and you say, I'm going to prepay some charitable donations for next year, increasing your itemized deductions this year, taking the itemized deductions, which will reduce your taxable income for this year, and then next year go with the standard deduction. So you can kind of play it year by year based on different expenses that you have that would qualify as an itemized deduction. So let's say, for an example, you add up my mortgage interest, state income tax, medical expenses, charitable donations, other itemized deductions, and that equals $40,000 for the year. That would be larger than the standard deduction, so I would go with the itemized deduction, further reducing my income from $100,000 to $60,000. And then it is that $60,000 that we go back to the tax rates here. And so we've reduced the taxable income to a $60,000 level. So we reduced it from the 24% tax bracket to the 22% in terms of a top highest tax bracket. And then it's that 60,000 that is then used to calculate your actual tax rate or the effective tax rate. All right. So moving on here to credits. Credits are typically better than deductions. The reason for that is because a deduction will reduce your taxable income that is then applied to those tax rates. So it's a percentage of a percentage essentially that you are saving. A tax credit is going to be a one-to-one, so a dollar for dollar reduction in your tax liability. So let's say we have that $60,000 of income, which we then applied to those tax rates. And then let's say our tax liability was, I'm just spitballing here, $8,000. So our tax liability is $8,000. If we go through these tax credits that I qualify for, and I qualify for $2,000 in credits, that's going to reduce dollar for dollar from $8,000 down to $6,000 in terms of tax liability, right? And to give you an idea of that effective tax rate, I would then take that $6,000 divided by $60,000. That's a 10% effective tax rate when I was in the 22% highest tax bracket. So that kind of is the difference between your highest tax bracket and your effective tax rate. But you can see a couple different tax credits here. Child tax credit is probably the biggest benefit, $2,000 for each child under the age of 17. So that is going to reduce your tax liability $2,000 for each child under the age of 17. That's huge. Make sure you're taking advantage of that. The dependent care credit, that's if you have or are paying child care credit, which enables you to work at a job and provide income. If you are doing that and have those child care expenses, make sure you're getting the credit for that to reduce your tax liability. You can see some other ones here. Ones that I like to highlight is the premium tax credit. Sometimes we see individuals delaying retirement because they don't think they can afford health insurance from the marketplace. There are generous premium tax credits, depending on your income, that you may qualify for to help offset those health insurance premiums. So don't necessarily delay retirement because of health insurance. If you're in that situation, come talk to us. Happy to help walk you through that. State-specific credits often might apply as well. One of the most common here in Utah is the 529 contributions. If you are contributing to, and this is kind of the key there, contributing to the state of Utah's My 529 program, that's where you get the tax credit. If it is to a separate state's 529 program, it does not qualify for Utah state tax credit. So just make sure you clarify there based on where your 529 account is held, whether that's for yourself or for kids. Also note these education credits don't have to be specifically for kids. If you have your own education expenses for you or a spouse, you can qualify for some education credits, likely through the lifetime learning credit, to help offset some of those education expenses. So another credit, and some of these ideas that the IRS has is to incentivize you to do certain things. Like in that example with education credits, to incentivize you to go back to school or provide some education to therefore increase your income and pay more taxes later, right? Kind of their strategy there. As well as the savers tax credit. This is a big one that I like to highlight. It can be upwards of 10 to 50% of whatever you contribute to a retirement account. So for low to moderate income earners, it can be hard to save for retirement. The IRS wants to encourage you to save for retirement by providing that savers credit, a little bit back, saving on your taxes for contributing to a retirement account. All right. So moving on here, I see some questions coming in. I'll get to them at the end as well. I just want to make sure we have enough time, because this is a big part of tax planning from financial planning perspective, is more on the retirement planning and tax efficiency side. Most, if not all of us, really all of us, have some qualified retirement accounts that we have access to. We can see a couple different examples here: pre-tax and Roth 401ks, individual retirement accounts, SEP or simple IRAs if you are or work for a small business, and then health savings accounts. Health savings accounts are a fantastic tool. Just a quick plug there. I'm going to go through pre-tax and Roth here next, but health savings accounts really add the benefit of both, right? It goes in pre-tax, so it's deductible above the line. Then it grows tax deferred, and then when you take it out, it's tax-free if used for medical expenses. So if you have a HSA health savings account, that is a fantastic tool in terms of tax efficiency. Make sure you are taking advantage of that. So what's the difference between pre-tax and Roth, and why is that important in terms of tax planning? Pre-tax, like we've already talked about, reduces your income above the line, regardless of whether you use the standard deduction or if you itemize. Roth contributions are a little different. You pay the taxes today on those Roth contributions. The benefit of those Roth contributions is that it grows tax-free, and assuming you're at least 59 and have had the account open for at least 5 years, that's all going to be tax-free income to you in retirement. So I mentioned towards the beginning of the presentation that sometimes it even makes sense to pay more taxes today to be more efficient in the long run. And that's what I was alluding to with Roth contributions. Depending on your effective tax rate for this year, it may be better to do Roth contributions, paying those taxes now at a lower rate, and then in the future, it's all tax-free when you're potentially at a similar or higher tax rate. Now, what I typically recommend, and again, this is going to be different for everyone based on your situation, but when you're younger, you're often, in a lower income, you may have kids or, different deductions or tax credits that you qualify for that slowly go away as you get older. So in a lot of cases, when you're younger, just starting out in your career, Roth makes a lot of sense. Then as you go throughout your career, as you start to make more, you start to lose some of those deductions and credits as kids move out of the house, you're making more in a higher tax bracket. the pre-tax tends to be more attractive. And so it's not just one size fits all or do one and that's it. It can vary. So a lot of people do Roth early on, switch to pre-tax, and then as they get into retirement, then they look to even converting some of that pre-tax to Roth, and then drawing from the pre-tax first and allowing the Roth to continue to grow. So there's benefits to both. I always say don't ever get hung up on this step when you're signing up for your retirement plan. But generally speaking, Roth can be very attractive if you have a lower effective tax rate. And then as you get a higher effective tax rate throughout your career, maybe consider switching to pre-tax until you retire. And then once you retire, there are different strategies, like I mentioned, with converting to Roth or optimizing your income strategy by doing a little bit from both. So it can be very helpful to have both pre-tax and Roth in your retirement accounts. All right, so just real quick, lastly, I did want to bring in kind of investment income into the mix and show how there are some exceptions to that rule of taking losses from one bucket and offsetting income in another. Your investment accounts may qualify for one of those exceptions here. An investment account is different from a qualified account, like your retirement account. We typically call these taxable or non-qualified investment accounts, where it's not tax advantage. So you're not getting the tax deferred or the tax-free status of a pre-tax or Roth account. You're paying taxes each year based on the interest, dividends, and or capital gains that you earned during the year. You can see the long-term capital gains tax bracket can be very efficient relative to ordinary income. So for example, if you see if you have your income low enough, for single about 48,000, if you're married about 96,000 for 2025, there's actually 0% tax rate on those capital gains that are long-term. So in that example, if I bought a stock for $100 and sold it for $200 2 years later, if my income is below 96,000 and I'm filing jointly, I don't have to pay any taxes on that. It's a 0% tax rate. And so looking at that, looking at some of the investment gains that you have, if you are below that threshold where you're in a favorable tax bracket in terms of investment income, you can sell that, you would realize the gain, but not have to pay any taxes on it. And then you can reinvest it in a similar but different, it's an important distinction there, a different investment option, and have a higher base in return in regard to taxes. The one exception that I mentioned that is common that you can take from your investment losses and offset some of your W-2 income is up to $3,000. So you can offset up to $3,000 of W-2 or active income from your investments each year. And so let's say I invested in Bitcoin, earlier this, a couple of years ago maybe, and then I lost $10,000, right? Bitcoin is volatile, that happens. Let's say that for this year, I offset $3,000 of my W-2 income with that loss. I have $7,000 of loss left on that Bitcoin loss. That rolls forward to the next year. And I can take $3,000 from that year to offset next year's income as well. So that's an example of some of those few exceptions that you can offset income from one bucket with losses in another bucket. Another exception can be within real estate. It's hard to qualify for that one. If you think that may apply to you, feel free to let us know. We're happy to talk through that with you. Just lastly, before we move on to questions here, I wanted to bust a few tax withholding myths, because we get these questions a lot, and oftentimes when people come to us saying, I got killed on my taxes, most of the time it's coming from improper withholding, improper tax withholding throughout the year. The first myth is that I need to have taxes withheld from my paycheck. Technically, yes, the IRS wants you to have taxes withheld from your paycheck, but you don't necessarily need to have a specific amount withheld. You actually have total control through your W-4 form how you have taxes withheld. A lot of people, specifically if they have volatile or variable income, don't have taxes withheld, and they make quarterly tax payments directly to the IRS. So if you have a lot of bonuses or commissions, that may be a strategy for you. Another myth is that bonuses or commissions are taxed at a higher rate. That's not true. Bonuses and commissions are withheld at a different rate, but they are not taxed. So a lot of times people have their bonuses have 20 to 30% withheld on that, and that's more than their typical paycheck has their withholding, because the IRS requires your employer to withhold bonuses and commissions at a slightly different rate. I always encourage people, unless you have very stable income and you know how much you need to have withheld, go to the IRS's tax withholding estimator. It's a good exercise to go through because it also includes a lot of those deductions and credits that we talked about to help remind you that you may qualify for those and see what that impact would be on your overall taxes for the year. Plus, it's cool. It'll show you a sample W-4 form that you would take to your employer to update your withholding based on the results that you get from that estimator. So that is a really good tool. You can just Google IRS tax withholding calculator or enter that URL there to find that. Awesome. I know I went through a lot and it's fairly general. Like I said, if you want to go more specific into your individual circumstances, we're happy to chat with you. Free consultations. As a reminder, we are a full financial services firm, so we can help with anything from financial planning, looking over your insurance, tax planning, estate planning, investment planning as well. We're happy to chat, do an initial free consultation with anyone on here today. Feel free to scan that QR code and schedule a time with us. I'm going to come back to this, but we have to go through our regular disclosures. As a reminder, before you implement anything, talk with a tax professional. And then just to highlight our upcoming webinars, I'm excited for next month's Handling Market Volatility webinar. Chad will actually be doing most of that as our market strategist. He'll be doing some great info there, and you can see the ones coming up. Keep an eye out for that. There will be a registration for April's webinar on the follow-up email we send out tomorrow. And again, don't hesitate to reach out if you want to schedule a time to talk with us. We're more than happy to meet with you. I'm going to get to the questions. If you have to jump off, that's just fine. If we don't get to your question, we'll try and follow up with an email as well to review that with you. All right, so we did get a question from Kevin. I'm retiring this year. Where do you recommend transferring my 401 to an IRA? That's a fantastic question. And so it does make a lot of sense as you get to retirement to start looking at those retirement accounts and within your employer plan. You don't have to leave them in your employer plan. You can if you want to, but oftentimes it makes sense, to Kevin's point, to move that out into an individual retirement account. Kevin, let's talk offline on that, because that does depend on your goals. It can make a lot of sense, like I said, to convert some of that to Roth in the early years of your retirement when your income is lower. So let's talk later about that, but that is a great question. Mortgage interest, at least from my understanding, has always been below the line, but it's possible that may have changed. Mortgage interest is one of those itemized deductions similar to charitable contributions and medical expenses that you only qualify for, or that you really only want to use if it's above that standard deduction. All right. Then Quinn, question about tax credit still effective if the child turns 18 during that year. My understanding is that the child has to be 17 by the end of the year. And part of that also is, right, as long as the child is born before the end of the year, you can still claim it. So if you had a child born on December 31st, you can still claim that $2,000 tax deduction. So once they turn 18, that tax deduction goes away. All right. I live in another state, but work for a company that is in Utah. Which state's 529 should I contribute to? That's a great question. It depends on the state, but most of the time, if you use your resident state's 529 plan or account, you can have that tax deduction from that state income. However, it depends on the state. Some states don't do that tax credit at all. So it does depend on the state. So you want to look into that on a case-by-case basis. Another question here, can we get the slides and the recording? Yes, the slides and the recording will be sent out. The recording link will be sent out in an email that we will get tomorrow to access that and review that if you would like. All right, another question here. My wife and I got married late last year. This is our first year filing as a couple. We both make about the same, so does it make sense to file jointly now? Great question. More often than not, yes, it makes a lot of sense to file jointly if and when you are married. The reason for that is the standard deduction is higher. There's more credits and deductions you can take advantage of. For the most part, it is favorable and beneficial to file jointly. The IRS seems to prefer that, and so it would be beneficial to file jointly. However, there are certain exceptions. One of the biggest exceptions that we run into is with individuals that have high student loan balances because of those income-driven repayment plans. Sometimes in that situation, if your student loans are large enough and your payment is high enough, it makes sense to file separately so that you can have a lower income-driven repayment through that. So that's a great question. It does depend on your situation, but for the most part, yes, it makes sense to file jointly. All right, another question about child education expenses. For the most part, child education expenses are not deductible, but 529 accounts can be used to pay for those education expenses. They've recently expanded the 529 accounts eligible expenses to include not just college education, but expanded that as well. There are also other accounts. Coverdell Savings Accounts is another education account that has even more for younger children, private schools, etc. So that's a great question, Joseph. I may follow up with you on that just to give a little more detail around those two different types of accounts. Yeah, great question. Can you briefly explain Utah's 529 account? So a 529 account, just real simply, is a tax advantage or tax deferred way to save for education expenses. That can be for yourself, that can be for your child, that can be for your grandchild, or any beneficiary that you want. You contribute to that account. In Utah, if you're using my 529, the state's program, you can get a tax credit for that for state tax. And then the money grows tax deferred, meaning that it acts like a Roth account. So you pay the taxes on it initially, it goes into the account, it grows tax deferred, and as long as you use it for qualifying medical expenses, that can be used tax-free for those expenses. If you use it for anything other than qualifying education expenses, then it'll be taxable and a small penalty as well. So you want to make sure you're only contributing to the 529 what will be used for education. It's a great question. Another question is it better to wait until I retire to convert the 401k to Roth because my tax rate will be less? I love that question. And it depends. For the most part, yes, if you are, mid to later in your career, typically in your peak earning years, so to speak, it would make sense to wait until you are in retirement to convert that and pay the taxes and move it to Roth. That said, it depends on your income year to year. Sometimes we'll see people, maybe they change jobs throughout the year and their income is lower for that year. Then it makes sense to jump on that and convert it to Roth. Or if you are certain that taxes are going to increase, which we didn't talk about the Tax Cuts and Jobs Act sunsetting this year, but taxes are set to increase next year. And so it might be good to bite the bullet, convert that to Roth, pay the taxes on that, and then not have to worry about it. But it all depends on your income and really what you foresee happening with taxes in the future, which can be very hard to predict. And then last question, I think here, what tax rate are you charged when you withdraw 401k funds? The rate you put it in or the rate you're at during retirement? Great question. So any distributions from a retirement account, at least pre-tax accounts, is added to your taxable income for the year you take the money out. So it's always added to your income and paid at your tax rate the year you take it out of the account. It has nothing to do with the tax rate when you put it in. And so that's why a lot of people look at their tax rate now versus in retirement when they're considering Roth versus pre-tax, although it is a lot more complex than that, as we saw. All right. Chad, did you see any other questions that I may have missed? I think we covered them all, and if we didn't, and it wasn't anonymous, I will follow up with an email as well to make sure we get all these questions answered.
Yeah, I saw you got most of them, if not all of them, covered. So I encourage you, if you do have questions and you were just a little bit shy about putting them in the question Q&A box, to reach out to us. Rocky and I are here to answer any questions, even as they come up going forward. So we want to thank you all for joining us this afternoon. I want to thank Rocky as well for sharing his expertise. I know I even learned something from it, so that's fantastic. Always learn something when I talk to Rocky. And I just want to say thank you all for joining, and I hope you have a great rest of your afternoon.
Thanks, Chad.